Michael Burry is the famous investor who bet against banks, he bet against Wall Street, and he bet against the entire housing market before the 2008 real estate collapse, and he was right. And his bet made him $100 million in profit for himself, and it made him $700 million worth of profit for his investors during a time when most people were losing everything during the 2008 downturn, during that crash. And now Michael Burry is back at it because he is selling everything. Michael Burry just sold his entire stock portfolio because he's worried about high inflation and he's worried about a potential economic collapse, and he's been buying just one stock. I'll get into what he's buying in just a second. Now, to be fair, Michael Burry is known to make bold statements and take bold actions. Like on August 4th, this is what he tweeted. He tweeted, "The silliness is back. After 1929 and 1968, after 2000 and after 2008, the strain of silliness that transformed bulls into bubbles completely and utterly disappeared. But that familiar COVID-era silliness is not dead yet, like 2001 before Enron, like 9/11 before WorldCom." Essentially, he's saying that he thinks that the market is going to crash, kind of like all the other market crashes that he listed out in his tweet. And not too long after making this tweet, he deleted his Twitter page, which he does pretty often. So if Michael Burry has been selling out of his portfolio and buying just one stock, one company, what is he buying? Well, he's been buying a stock called GEO. What is GEO? Well, they're essentially a prison company. They own and build prisons. Now, before you sell out of your entire stock portfolio and buy this prison stock, I want you to understand that Michael Burry has different goals, he has a different risk tolerance, and he has a different investment horizon than you probably do, which is why you want to make sure you do your own financial research and you don't blindly listen to anybody, not even a random guy on YouTube. But let's talk about why Michael Burry is so worried, because he's openly talked about this on his Twitter page before he deletes it, but he says that the number one thing that we need to be worried about right now is inflation, because of all the money printing that we did in 2020 and 2021 and even into 2022. All this money printing has caused so much inflation, and now the Federal Reserve Bank and the government are needing to pop the bubble. They need to pop the inflationary bubble, even though they're not fully doing that. But when they pop the bubble, it's going to cause economic pain. That's going to trigger a sell-off in the markets, and that's what he's worried about. We have the Federal Reserve Bank that is actively taking action to fight inflation. Like, they've started doing this quantitative tightening, and they're working to raise interest rates as a way to fight inflation. But on the other hand, the government is saying that inflation is a big concern and a big problem and that they want to fight inflation, but at the same time, they keep spending money that they don't have, which is inflationary. They're spending money through bills like the Inflation Reduction Act, and they recently passed the Student Loan Forgiveness Plan, which is another inflationary plan. Here's what Michael Burry had to say. With recent spending bills, including the student loan forgiveness, now approaching $2 trillion this year, we have the emergence of a fiscal put. And then he went on to say that it's not just COVID anymore, and it will be as good for America's economy as sugar is for babies. A put, by the way, is a financial term, and it's something that you use when you expect your investment to go down. Now, we've covered the whole pros and cons of the student loan forgiveness in Market Briefs, which is my free financial newsletter, which is why if you haven't subscribed to Market Briefs, you should do that, because it's a super easy way for you to stay up to date on what's happening in the markets. If you are an investor and you want to stay up to date on the stock market, the real estate market, the crypto market, inflation, and the global economy, it is a free way to do that. It's easy to read, and you can read it in less than 5 minutes every morning, because now you'll stay up to date, and I promise you, you're going to look forward to reading Market Briefs every morning. So if you want to join Market Briefs, it's completely free, and I'll put the link to how you can do it down in the description below. So Michael Burry is saying that on one hand, we have this inflation fire going on, and the Federal Reserve Bank is using this little hose to fight this fire, while at the same time, you have the government that is spending money, aka adding more fuel onto the fire, which is inflation, by constantly spending money that they don't have, which will ultimately make the inflation problem worse. Now, at this point, you might be saying, but Jaspreet, what about all the bailouts for corporations and the money for big businesses and all that? Why can't regular people get some money too? Look, the reality reality is that they're both bad. They're both inflationary. I talked about this when the whole PPP thing was happening. I talked about this when the bailouts happen for big corporations, and I talk about it when it happens in the form of stimulus checks. It's all inflationary. That's one of the reasons why I did not accept any PPP money from the government, because I know the cost of this money. But if we focus solely in on the inflation side, we look just at the numbers, you have two different opinions about what's going to happen with student loan forgiveness and inflation. On one hand, you have the CRFB, which says that the student loan forgiveness is going to be inflationary and that it's, quote, going to eliminate any disinflationary benefit from the Inflation Reduction Act, because they're expecting the student loan forgiveness to add 0.2% in PCE inflation to Americans. In other words, they're saying that the student loan forgiveness is going to cause more inflation. Then on the other side, we have the Center for American Progress, which is saying the opposite. They start off their talk about student loans and inflation with this sentence: inflation is not the lens one should use to analyze the student debt crisis. In other words, just because we have all this inflation going on does not mean that the inflation should affect how we look at student loans and student loan paybacks. But then they went on to talk about inflation, where they said that in the United States, last month's inflation data showed that inflation is already cooling and that consumers expect inflation to decline. AKA inflation is getting better and you don't have much to worry about in terms of inflation here in the United States. And then they gave this Roosevelt Institute study which argues that canceling student debt would not be inflationary, particularly because higher wealth is unlikely to drive spending. In order to really understand that, you have to understand what inflation is. Inflation is when you print money and then you spend this money. And so now when people have more money in their hands, they can spend money, which creates more demand, causing the price of things to go up. That's why when you see all the issues with the supply chain mess going on right now, the supply chain mess is a byproduct of inflation. The supply chain didn't cause the inflation. You printed all this money, gave it to people when people weren't working, and now people can buy stuff when nothing's being produced. That causes a supply chain issue. That causes the price of things to go up. So inflation causes supply chain issues. The supply chain issues do not cause the inflation. And what it's saying is that just because now people will feel wealthier, aka you have less debt, people might not go out and spend more money, so it's not going to cause more inflation, because if people are spending more money, that means we have more demand. If there's more demand, that causes more inflation. It causes the price of things to go up. But that's also ignoring the fact that you have to spend the $300 or so billion to actually pay off the debt. There's a cost to that because the government doesn't have $300 billion laying around somewhere. And it's also making a pretty big assumption that when people are wealthier, they don't spend more money, because I always thought that when people became wealthier, they spent more money because now they have more ability to spend, minus the maybe 0.1% or 1% of people that don't inflate their lifestyle when they become wealthier. But that's just their argument. So you have to understand that it is inflationary when you pay off the debt, but they're arguing that just because people are wealthier, it's not going to cause more demand for things, because if people feel wealthier now that they don't have student loans, that they will go out and spend more money, and they're saying that that's not going to happen. In any case, this is where Michael Burry says that inflation is a problem and it's going to be a painful problem to solve, and because of that, he's been worried and selling out of his stocks and buying prison stocks, because he believes that this prison stock is a less inflationary driven investment and that it'll be more recession proof, which is why he's investing it there. Now I'm going to say this one more time before you just go and blindly follow what anybody else does. Make sure you do your own research. You don't want to just blindly follow what someone else does, because they have a different risk tolerance, they have a different investment horizon, and they have different goals than you. And so you want to make sure you're doing your own research and make sure you have a strategy with your investments. Now, of course, you want to stay up to date on what's happening in the markets. Make sure you join Market Briefs. It's a free tool that I created for you. Now, people have jobs and unemployment is low and wages keep going up. You would think that this is a good thing. And it is a good thing when you are in a strong economy that's robust on its own. But when you're in an economy that's been reliant on so much cheap debt, that's been reliant on so much free money, that's been reliant on so much money printing, these things that you would think are a good thing are now hurting that same economy, according to the Federal Reserve Bank.